Hello and welcome back. My name is Josh, and as you can tell, I'm not in my normal recording area. I'm actually on vacation in Florida. It's now a little later. I've been working remotely and part-time and vacationing the other part, much better than back in Toronto. But I had a little time, so I wanted to make a quick video on something that's very topical, and you might hear now that we're just around the end of the year. I'm recording this on Christmas Eve, and that's tax loss harvesting. So you might have heard this, maybe not, but what is tax loss harvesting? Because I think this is the most common time. If you are going to hear it, it's going to be now. So tax loss harvesting is the idea that you can actually sell something for a loss and pay less in taxes. So how does this work? Well, when a stock goes up, if you don't sell it, it's called unrealized gains. Unrealized gains mean you haven't actually realized the gains or the profits. It's just on paper. You know, if a stock goes up 10,000% and then it goes down 10,000%, you haven't actually made any money. So until you actually sell it and have the cash on hand, it's called an unrealized gain. You do not pay taxes on unrealized gains, which makes sense. If your house goes up 20%, you don't pay a tax because your house goes up. You might pay a higher property tax, but you're not paying tax on the appreciation in your house price. But when you sell your house, you may have to pay taxes. It depends on your local regulations. I know that for me in Canada, you do not have to pay tax on the appreciation on your house if it's your primary residence. So in other words, if you own 3 or 4 houses and some of them are investments, you have to pay if they go up in value, but if you're living there, you don't. So same idea with stocks. Let's say you sold a stock. I did this year. I sold a bunch of stocks. I actually sold Prologis, PLD, and made a profit. So again, you have to make a profit for this to work. So if you had 50 shares, $100, and you sell it for $200 per thing, you've obviously made why am I not speaking correctly? $10,000. But you started with $5,000, so you made a $5,000 profit. So I want to be clear. So this is the realized gains. This is the amount you gain, and now that you've sold, it's realized. So you have cash on hand. So again, you have $10,000 cash, but 5,000 of it was profit made out of thin air because before you only had $5,000. So you're only taxed on your profits, this $5,000. Now tax rates are going to differ based on where you live and even your income bracket. So I know here in Canada, I'm not here again right now. I'm in Florida, but where I am in Canada, your tax bracket goes up based on your income, and when you sell stocks, it's counted as it goes against your income. So if you sell more stocks, the it could push you into a higher income bracket. So typically, you're only paying on half of your profit, and where I am, the most common tax bracket is about 30%. So instead of half of the profit and 30%, I just did half of 30, and so the tax you're going to pay approximately is 15%. Hope that makes sense. So instead of paying 30% on 2,500, we're saying it's the same as paying 15% on 5,000. So this means that at the end of the year or next year, when you pay your taxes, if you got a $5,000 profit, you're going to have to pay the tax man $750. Quick thought: why is it always the tax man, not the tax woman? Food for thought. Um, Heartless tax collectors can be women too. No, I'm kidding. I mean, they can. Um, so you have to pay $750. Now, let's say you had another stock. So one did very well, it doubled, and you made $5,000. Good, that's awesome. You had another stock, you had 100 shares, it was $100, and now it's down to $80 a share. So you've actually lost 20%. Again, until you sell it, it doesn't matter that you've lost money. I've had stocks go down and then they've rocketed back up, and I've ended up making lots of money on them. But let's say you no longer believe in this stock and you want to sell it, or there's other reasons, maybe you don't want to pay the 750. This is not a good reason to sell a stock just because you don't want to pay taxes. But if you don't believe in this stock anymore, then it could be a good idea to sell. So if you sell this stock, you realize a loss of 2,000. So again, you started with $10,000, you sell it, you get $8,000. That means you've lost $2,000 on paper. So what you end up doing on your taxes is you end up adding these two together and only paying on the net amount. So you made $5,000, you lost $2,000, so your actual gain is only $3,000. And so you only pay the 15% on the $3,000, so that works out to $450. So in essence, by harvesting this loss of $2,000, you save $300. Now, again, if you think this loser is a great stock and it's going to go up, don't do it to save $300. If you think it could go back and you think it's worth 150, don't lose $2,000 or potentially even more to save 300. That doesn't make sense. This is more if you think, often I'll use it if I think I've made a mistake. So I did that earlier this year. I invested in a company called Agora. Their ticker is API. And let's actually look at API stock. They have done awful. I bought it, I think it shot up. I think I bought it around here after a big dip, $60-ish. I thought, ooh, that's a big deal. It was just higher. And I liked the business model that they basically create an API that allows you to do video chat. So if you built an app, you don't want to build the video chat portion yourself. So you can say, hey, Agora, let me give you some money and I can easily build an app with video chat capabilities in it. That way I don't need all the tech. I can just build the actual app and you can just handle the video processing and video streaming portion of live video chat. So again, I have an app idea for, I'm going to make an app that lets doctors speak to patients. You just need to focus on the actual app part, not all the technical parts of how the video streaming and video chat's going to work. And I love the business model. I did some analysis and it looked good. And then a couple months later, I said it kept falling, keep falling, keep falling. And I did some more research and I found out Twilio, which is a company I also used to own and I'm a big fan of. And if we look at Twilio here, Twilio stock, it's also had a bit of a wild ride. I also did well here. I think I bought around here-ish, 250, sold not quite 400, pretty close, and now it's down 37%. So I like Twilio, but basically I only knew Twilio as a company that did phone and text. So right now, if you use Uber ever and you get a text from Uber or a call from your driver saying, hey, Uber will be here in a couple minutes, Uber didn't develop that capability. They're using Twilio, which allows you to easily send text messages and calls. Well, they also actually have something similar for video chat. So they have an API to allow you to do video chat. I didn't know that. And when I read some research and it said Agora is actually not winning customers at the same rate as Twilio, I said, you know what, Twilio is a bigger company. This is a $2 billion company. Twilio's $47 billion, way bigger. Twilio has a way wider array of products. They have SendGrid, which is for email. They have call, they have text, they have video chat. So they have a much larger, they can cross-sell much more easily as opposed to Agora. And Agora is also actually, as you can see, it's headquarters China, so it's also got the China risk. So I was like, you know what, let's sell it. And so, I lost a bunch of money. Again, I bought it around 65. I think I sold around 33. Again, I would have lost even more if I kept holding on. So I'm happy I didn't keep holding on, but that's the point. I said this is a bad company, and so I took a loss. And on paper I lost $500, but I can now write that off against my gains. Sometimes you might want to do something similar. And I just listened to a podcast with Manish Prabrai, who's a famous value investor, and he mentioned that he held Alibaba, which is a Chinese company. Speaking of China, and he sold Baba because, well, so first let's say that there's two things. He said people only buy a company for one reason. They think it's going to go up, but they could sell for many. You could sell because you see a better opportunity out there. You think it's still a good company, but you think there's a better company for diversification. You know what? If you bought Tesla when it was here and you had 10,000 shares and now it's 1,000, you might want to diversify. You don't want your whole portfolio to be 99% Tesla. So you might want to sell even if you believe in Tesla because you say, you know what, I want to diversify a little. So there's many reasons to sell. You could tax loss harvest. There's only one reason to buy, which is you think it's going up. So he actually sold Baba. He said, I still like Baba. I still think it's a great company. But as you can see, it's down. So it has to go down, which is why he was tax loss harvesting. And instead he bought Tencent, which as we can see has a very similar, it's also been down, not as extreme. It's down 37% as opposed to 55%. But he said, you know what, he likes Tencent better. And he said, okay, so I can, instead of just using cash from something else or cash from a company that's doing well, he can sell this, take the loss and lower his tax obligation, and buy something else that he likes. You could do the same with like Walmart or Walmart and Target. You think like those two probably are pretty correlated. You know, when retail does well, when big box stores do well, they probably both do well. And if the economy's in the tank, they're probably both going to do poorly. So if you want to sell one and buy the other for tax loss harvesting, you can do that. Now, I will note again, I'm not a tax expert, and this is opinions, not advice, but I do know that you can't do this. You can't skirt the system. So they say it can't be an equal or equivalent product, like investment product. So here we have ZG, which is the stock ticker for Zillow Group Class A shares, and Z, which is the Class C shares. So the only difference, you'll see there's a slight price discrepancy, but one has voting rights, one does not. But otherwise, you can see they look the exact same. And that's because they're both invested in Zillow. And so you couldn't say, oh, I lost money when Zillow announced they're not doing iBuying. So I'm going to sell this, but I still believe in them long term. So I'm going to harvest the loss and then buy in and buy the Z shares instead of the ZG shares. Can't do that. They won't let you harvest the loss. You can do it, but they won't let you write off the taxes because it's an equivalent thing. Now, if you said, I want to sell it and buy Opendoor, which does still do iBuying, you could do that. So those are obviously different companies, but they're correlated. So you can have different companies that are correlated, but you can't buy companies that are basically the same. Similar with like, you know, if an ETF is like an American version of the same or a Canadian version of the same ETF, they won't let you do that. Again, if you're thinking about this, consult with a tax expert, but this is the general thing. Again, I don't want to encourage people to skirt the laws. But yeah, that's tax loss harvesting, and I think it can make sense if you do. I think now is a good time to rethink your portfolio. Say what's been going right, what's been going wrong. This is why everyone wants to do it, because you have to get in by the end of the year. So that's why you'll hear tax loss harvesting a lot at the end of the year. And companies that have typically done poorly, they might see an uptick in the number of sales at the end of the year because hedge funds and fund managers are trying to trim these positions to get this tax advantage. So they're going to try and do this. The last thing I'll note, if you do sell it, you can buy the stock again in 30 days. So if you said, I believe in Zillow, but I want to, you sell it now, in 30 days, you can harvest the loss, and then 30 days, you can buy back in. But, in 30 days, which is about a month, maybe it's flat, maybe it's up. So, if it's up 13%, if you did that a month ago, sold it, harvested the loss, and now bought, yeah, you saved a little, but, if you lost 13% on the trade, maybe that more than offsets the gain that you got by lowering your tax obligation. So again, I would not say, this is my opinion, but I wouldn't say use this as a strategy. Don't just sell to lower your tax obligation. Make sure you think about the company first. Always think, is this a good investment? If it's a great investment still and you still think it's going to 10x, don't gamble to save a couple bucks here or there on your taxes. Do this with what's the stock that you have least conviction about, that you're least sure about? Is it down? If so, maybe you want to sell it and harvest the loss and look somewhere else. And it's also a good excuse because oftentimes once we buy in, if we're down, we don't want to sell. We think it'll bounce back, and that's why people often, you'll see these, there's an ugly one, but people say, oh, I bought it 150. It's got to bounce back. It's got to bounce back. And if you held it, you're way down, and that's because the stock market doesn't really care where you bought it. It's down 70, almost 70% from its highs. It doesn't know where you bought it. Doesn't care. It's just going to reflect value. So again, if you sell it here, I doubt it goes back to 150 in the next 30 days. But if you really want to harvest this loss, you could harvest the loss. 30 days later, buy back in if you're a believer. Again, I'm using Zillow as an example. I'm not, but I'm not selling it. I'm actually a shareholder. I do believe in the long term. But just be aware of the risk, and also be aware that if you are buying back in 30 days and then it does go back to 150 in a couple of years, you got to pay taxes on that higher amount. And if you held it here and it goes back to 150, you don't have to pay taxes. Again, assuming you don't put it in the tax shelter thing. But again, consult a tax expert. I know it's not the most sexy topic, but it is something important to do. Is you do want to make sure that you're not just investing in great companies, which is key and important, but also you want to do that in the most tax advantage way. So if you have a Roth IRA or a TFSA in Canada, which is a tax-free savings account, make sure that you're doing that because taxes can have a huge impact. I have, if I were to sell Tesla, I'd have to pay a lot of money in taxes. It's quite significant. So I don't want to do that. But unfortunately, when I do sell, I'm going to have to because I didn't do it in a tax-free savings account. But make sure you're maxing out your tax advantages. And this is one way to do that. So hopefully this was interesting. Thanks so much, and talk to you next time. Cheers.